Hello, friends. Welcome to the Weekend Investing Stock Market Weekly Review for the week ending 21st of February 2025. Uh, Nothing really great that happened this week from the market's perspective, but from our research desk, we had some great stories to tell you. Uh, there was a story about skewed bell curve, how the outliers really you know set you off from your regular path. Uh, Impact of FIIs, cutting out noise from your investing, impossible to ignore gold, lump sum versus SIP study, a market not no reason to complain in the market if you look for from a long term perspective. 80% of managers not having seen a bear market, sovereign stupidity, an article about that. This phase has similarities to past market crashes, so we try to correlate current fall to past falls, and survival of the fittest, a story about how by staying with the fittest stocks you can survive. All this and more, and you can also get this on the daily newsletter, and also can read it on the blog on the website, or can also see it in the Weekend Investing app. Please do read the disclaimer fully and do subscribe to the channel if you haven't so far. I know 30% of you haven't so far, so please do that. Nifty is at a very precarious edge of a fall. The last six sessions, we have almost touched this 22,800 level each day and not yet fallen. So, a big catalyst can be, a US market fall, which happened last night, Friday night, market has fallen there. Could precipitate some more fall in the Indian market. Although right now the market looks like it is not willing to fall any further, right now at least. This is not to say that the bottom has been made. That is a very difficult call to do. And that is usually accompanied by some kind of very sharp capitulation like this one, uh, or a very sharp up move like this one, which has a potential to take it higher. Uh, so it's difficult to call it. When the markets will bottom, whether now or 6 months later, nobody really knows. But the last 4, 5, 6 sessions, the has reduced, the volatility has reduced. Uh, we are at the edge, not yet toppling over. Um, but the US market probably has more cues now that if the US starts to fall, maybe we'll have some fall to start with. But then I believe that we will not toe the US line anymore because we haven't done that in the last 4 months. So funds coming out of the US markets are likely to go to other markets. So there could be a some sort of a base that forms here as the US markets fall, and US markets are probably at that verge of maturity where some fall is now expected. um, the rules of the game are changing there as well, very very rapidly, not just for other countries. um, and inflation is likely to come back, uh, with a vengeance there, with all these tariff talks, and the domestic user or consumer is also going to get impacted. Nifty on a weekly chart, you can see, is still hovering there. It's a doji candle, indecisive. Um, this last leg practically has been almost 3 months long now, and after a 3 months long fall, usually you will see at least a month of a rally like this one. So that is the expectation. Let's see where we create that intermediate bottom. But the narrative right now is very bleak, uh, which is not helping at all. And the US market, which has so far done all right, we are still at the highest close, um, is plateauing out for now. Let's see if it can really break out and go higher. It has been on a tear since October 90 to 2023. So a relentless rally in the US, and once we do break some pivot of the US markets, it is at that point where some funds will start to at least not go to the US market, if not come out of the US market, and that probably is going to be a relief for FI selling here. Gold in rupee terms, another 1.74% up this week, closing at 86.16. So gold, and actually the US markets have done really well uh, from October 2023. Um, Indian market was doing very well till September, October 24, and then we fell off from here. But these two markets have done really well. I mean, just see almost 50 to 60% kind of a jump has happened here. And if this was a significant, not 1, 2, 3%, but a significant part of your portfolio, uh, it would have done wonders to your portfolio right now. Many gold hedged portfolios are sitting at even no losses at all. Dollar index down 0.11%. So this is beginning to cool off and thaw. This is very good news for emerging markets, for precious metals. I hope we come down further here, uh, and that will give some respite to the Indian rupee as well. In If we look at the benchmark indices, in the last 1 week we had some minor gains in mid caps, Nifty Next 50, Nifty small caps, but no real gain over the broader market at 0.28%, and Nifty has actually been in negative. In the last 1 month, we are still very much negative on all the indices, almost 11% on small caps. On last 3 months, again the same picture is there. In the last 6 months, we've gone down 18% on Nifty Next 50 and Nifty Small Caps, and 8% on Nifty 50. And in the last 1 year, we are now down negative 2% on small caps, plus 2% on Nifty 500, 3% on Nifty, 3.5% on Nifty Next 50, and 4% on mid caps. So mid caps have performed the best in the last 1 year. Of course, over longer periods of time, the market still looks quite good. All segments of the market in good double-digit gains. Over a 3-year period, also, Nifty is up about 10% CAGR despite all this fall. Within the sectors, if we see, in the last 1 week, we had autos go down the most. Autos, pharma, both getting hit by the US uh, talk of higher tariffs. FMCG is anyways very weak. IT stocks also weak this week. Defense stocks moving down, although defense did come back up from midweek, but it was much more down at the start of the week. And banking space is in the middle, not really moving anywhere. And some recovery happening in PSU banks here, some more recovery in energy, public sector enterprise, metal stocks, and capital markets leading the entire uh, bandwagon. In the Nifty sectoral momentum overview, which takes 1 year, 6 months, 6 months, 3 months, 1 month, and 1 week rankings in purview, you can see tourism, financial services, metals, and services sector. These have been leading the top 4 or 5 ranks. Capital market, which had got beaten down a few months back, is now recovering very rapidly. So if you look at the top part of this table, you will find sectors that will probably are the leadership position right now in terms of momentum. And if you see the bottom part of this table, you'll see energy, defense, FMCG, public sector enterprise. These sectors are really the ones that probably will have the least number of potential, trades coming out from that space. Let's look at some trends now. So CNX 500 stocks above 200 DMA, just 16%, and just 12% above 50 DMA. So very, very poor positive breadth in the broader market. Uh, and it's not really improving yet. Once it starts to go, let's say, above 30 or 40 right here, then really in this kind of a move, then really you can say that it is improving. Right now it is absolutely at the bottom, languishing there. On the benchmark indices, um, 200 DMA stocks, so stocks that are above the 200 DMA, again, very, very poor. On most indices, you have more than 80% stocks are below the 200 DMA. And from a trend perspective, you don't want to touch stocks which are below the 200 DMA at all. So significant part of the market basically is not investable from a trend perspective. It may become interesting from a value perspective, but we are not looking at that from this angle. Nifty 50 also has almost three-fourth of the stocks below 200 DMA. So it is really down and out the trend right now in the markets. If you look at 50 DMA, also almost 88% of stocks in all these three sectors, three indices, 92% in small caps, and 66% in Nifty are above uh, the below the 50 DMA. So really bad breadth, especially in small caps. I mean, 8% of stocks uh, above the 50 DMA is a very poor number right here. So 8 meaning 20 stocks out of 250 are above the 250 DMA. The Let's go to the next slide. The trend check on different sectors. Metals seemingly have the fastest current, on the smaller trends on 20 DMA. But let's go to 200 DMA. IT still remains the space where most stocks, 70% stocks, are still above 200 DMA. Financial services, private banks are the next ones, but the number is dropping very sharply here itself. And for the rest of the market, it is virtually 0 or 10% or 20%. So very poor numbers in each sector that are really above 200 DMA and looking up. um, so this also is telling you how bleak the picture is, and it could get worse. I mean, nobody is really calling the bottom here right now. With financial services, metals, and commodities have some, stocks within their sector that are moving up above 50 DMA. So there could be a case where prices are bottoming in some sectors, moving up. So they move up above 50 DMA, but 50 DMA has not yet moved up above 200 DMA. That is a possibility. uh, so look out for stocks in this space going forward. If these stocks also move above the 200 DMA, you may start to get new setups for stocks that are likely to trend up further. If you look at the strength and weakness within the CNX 500, there's a concept of golden cross. Golden cross is basically when 50 DMA moves higher than 200 DMA. So only 28% of stocks are in that position where 50 is more than 200 DMA, and 72% are in the death cross where 50 DMA is less than 200 DMA. Absolute strength metric is where price, where all the studied DMAs are getting aligned. So price is greater than 25 DMA, is greater than 50 DMA, is greater than 200 DMA. Only 3% of stocks are satisfying this situation. So 15 out of 500 stocks are satisfying this situation, and absolute weakness is being satisfied by 54% of stocks. So that also tells you how extreme weakness is there in the markets from almost every perspective that we are looking at. DII status and FII status has not changed much. FIIs continue to sell, although they did have one big day of buying of a block deal. But other than that, it has been a continuous selling proposition. DIIs have continued to buy. Fortunately, this buying has not yet gone away. Cumulative over the last 1 month, DIIs have pumped in 72,000 crores. FIIs have taken out 67,000 crores. So it is very much a fair, balanced game that has been going on. Hopefully, and one can only hope for that FII flows will start to reduce as soon as US markets start to come off, or the dollar index starts to move down, or maybe there is a concentrated attempt by the new president of the US to weaken the US dollar versus other currencies. So that is a tool that they want to use at some point where they want the dollar to go weaker. and once that starts to happen, a fund outflow from the US towards the markets should start towards emerging markets. So that's all I have for this session. Thank you so much for watching this. Have a great weekend, and I'll catch you the next week. Thank you. Bye.